The real yield, the inflation-adjusted yield, negative, way out above 2. It's come back, it's 2%. Where is that yield, the inflation-adjusted yield, in 1 year?
It's difficult to say, but it's likely to stay lofty, but it'll probably come down. And the central argument for that is the Federal Reserve. One should have confidence in the institution, that is, in its ability to foster price stability. It may be difficult to get to 2%, which is its inflation target. We see today inflation over 4%, and it's been there for some time, and it peaked in the 6s, hit 9% for the overall level. But the Federal Reserve has a sufficient arsenal to bring the inflation rate down, and so one has to believe in its ability. Now, fostering price stability is different than getting to that 2.0 in the sense that the different definitions of price stability. Some could say it's 2.0%. But Alan Greenspan, former Fed chair way back, would say that price stability is achieved when price levels cease to be a factor in decision-making for households and businesses. That's likely to be the case before long. We see the inflation rate continuing to move down in 2024.
But the key thing here to the real economy is the new positive interest rate is tangible sector by sector through the Standard & Poor's 500. Are we going to, Yardeni's calling this an equity bull market, a roaring 2020s. Is this a real economy that can withstand this new interest rate regime, this post-pandemic regime?
Well, yields today are attractive relative to history. Today's yields doubled last decade's average. It's higher than the 20, 30, and almost near the 40-year average period that includes higher interest rates. It's attractive relative to expected inflation and expected volatility. The economy can handle it to some extent, but it can't in one major way. And this you see playing out in government bond markets. Think the UK in 2022. Prime Minister Truss suggested lowering taxes without giving a solution for paying for the increased indebtedness. The bond market pushed back violently. The yield on the 10-year gilt, as it's called, the government bond there, rose 150 basis points rapidly. You could say the bond market vigilantes came out and disciplined the fiscal authorities, and Prime Minister Truss was ousted. I like to call it, because I wrote a book about this idea, a Keynesian endpoint. Keynesian endpoint where we reach practical limits to the use of debt.
No, that's where the Dodgers buy Ohtani for more money than God. That's a Keynesian endpoint.
So the world is seeing that. So the high levels of debt do make it more challenging for nations to have high service costs. And here's one idea. What I call the read my lips moment ahead for perhaps the United States and other nations. Read my lips for George Bush, 1988, in a speech written by Peggy Noonan, Ronald Reagan's famous speechwriter. At the convention, he said, read my lips, no new taxes. He had to break the pledge 2 years later because the interest on the debt rose to 3.2% of GDP, which was a record that still stands. Well, in a few years, we'll breach that. Politicians like Bill Clinton and his Treasury Secretary, Robert Rubin, solve the problem. We eventually had budget surpluses, but Washington doesn't seem to be the kind of place these days for those types of solutions.